I know you to kind of just be a laid-back guy, just trying to keep things calm, but you got the markets excited earlier this month. You put out a note forecasting no Fed rate cuts this year. You said the Fed's going to spend all year trying to fight inflation. How important is today's CPI read to your thesis?
It is very important, Frank, because what's going on is that since the Fed meeting on December the 13th, we have seen a very significant rally in the stock market. We've seen a very significant tightening in IG credit spreads, in high yield credit spreads, in loan credit spreads. And we have seen, generally speaking, financial conditions that have eased with IPO activity coming back, M&A activity coming back. All these things are a significant tailwind to the economic outlook, in particular to consumer spending, but also to markets, broadly speaking, in terms of what's going on with corporate finance, namely capital markets, and for firms. And all that means that we will probably see another lift in the economic data because simply people have more money in their hands as the stock market has gone up. And as you just spoke about, Bitcoin prices going up, the wealth effect is going to be quite meaningful for consumer spending. And that all will spill over to provide a tailwind and a lift to inflation over the coming months.
So, Torsten, you see a lot of tailwinds when it comes to inflation. You mentioned it just now, the strong stock market, Bitcoin, strong cash flow, even from fixed income. But I do want to ask you, you believe at the center of this inflation story is housing inflation. What turns around the housing story that we have right now? I was just looking at rates. They're just under 7%. They are under 7%, which is a key sentiment level. But still, there's about 60% of Americans with a rate, a mortgage, under 4%. What creates more movement in housing to create that inflation that you're looking for?
Yeah, this is really important because there was a lot of debate in markets when the January CPI data came out that, there was a lift to housing inflation. And people said, this is just a statistical issue. This is not real. But what if it actually is real? Exactly because people have been making more money in the stock market. Everyone still has a job. We got 275,000 jobs created, of course, in the month of February. What if this is not just a statistical issue? That's the reason why housing inflation is beginning to reaccelerate. What if this actually is because more people are out there looking for homes, and several housing indicators have begun to show signs of life and therefore more signs of a rebound? So the key issue to that discussion, Frank, is that, maybe we will get more of a boost to the housing market. Despite, as you're saying, that mortgage rates remain at relatively elevated levels, we still have quite a significant support from people simply having more cash. For example, you saw in Manhattan that 2/3 of home sales and housing sales in the last month was driven by cash sales.
Okay.
So people having bigger gains in stocks, Bitcoin, in asset prices is certainly providing a tailwind for housing, at least for the next several months.
But, Torsten, in all fairness, New York City is a bit of an outlier. You're talking about cash sales. Those are very wealthy people. In other parts of the country, rents are actually coming down. But I just want to go back to the numbers for a second. You are a numbers person. So right now, the estimate is for that core CPI to come down to 3.7%. If it's at 3.7% or lower, do you change your thesis? Does that change your outlook for those Fed cuts?
No, because what's really important to remember in that discussion is that the Fed has an inflation target that's 2. And all the numbers that exactly you just said that the consensus expects of 3.1 or 3.7, all those numbers, of course, are still substantially above 2. And this is the whole reason why FOMC members more recently have come out and said, well, hold on, we still have inflation that's a little bit too high, namely at levels that are quite significantly above the 2% target. So the bottom line in this discussion is, yes, inflation has come down from 6, 7, 8%, depending on how you measure it, in the summer of 2022. But we are just not quite there yet. And by taking the champagne bottle out a little bit too early here from the Fed at the December meeting, we run the risk that we begin to see more tailwinds to the economy, and therefore more risk that we'll see tailwinds and a lift in inflation over the coming months. That's the reason why we expect rates to be higher for longer.